You have probably seen this. A stock rallies suddenly after a company announces a dividend, or maybe crashes after a bonus issue or right offer. But why does it happen? Corporate actions are the behind-the-scene events that the company uses to reward the shareholders, raise funds, or restructure themselves. और अगर आप स्टॉक मार्केट में सीरियस हो, you must understand these actions clearly, क्योंकि इनका सीधा असर पड़ता है आपके पोर्टफोलियो पर. In this video, we'll break down the 5 most common corporate actions: dividends, bonus issues, buyback, stock splits and right issues. ये actions voluntary भी हो सकते हैं, mandatory भी और sometimes conditional भी. They usually affect the number of shares outstanding, the share price, shareholder entitlements and the company valuation sometimes. अब शुरू करते हैं the most common action से. Dividends, that is sharing profit with the shareholders. Dividends are the company profit distributed to the shareholders. There are 2 types of dividend. First is cash dividend. They are directly credited to the shareholders' bank account. For example, 10 rupees of dividend per share is declared and you have 100 shares in your account, so you will get 100 into 10, that is 1000 rupees of dividend. Second is interim and final dividend. Interim, that is they are declared mid-year, and final declared at the end of the year, that is post AGM. Few key dates are record date. You must hold the shares by this date to be eligible to get the dividend, and X date, it is 1 trading day before the record date. Stock prices usually adjust. What is the impact of declaring the dividend? Stock generally falls by declaration of dividend on the X date. It is logical because cash company के पास से निकल गया है. Example, Infosys declared a dividend of 20 rupees, so the stock price might fall by 20 on the X date. So now the question is, why do companies do so? The answer is to reward the investors, especially when there is consistent profit but limited reinvestment need. Now we'll talk about the bonus shares, that is free shares to the shareholders. Bonus is issuing free shares for free using the reserves from the company's book. For example, 1:1 bonus is you held 100 shares, you get 100 bonus, so total shares with you will become 200. But why do companies do so? Because bonus improves the liquidity, especially if the stock prices are high. Also, the price adjustments take place. Price gets halved in 1:1 issue, but there is no gain or loss in the value. Your holding value remains the same. This is a cosmetic move, but can psychologically attract the retail investors. Companies like TCS, Infosys, Wipro have historically used bonuses to increase their share base. Now we'll talk about share buyback, that is reducing the number of shares. Buyback is a process in which the company buy back their own shares from the shareholders. It reduces the total outstanding shares. But why do companies do so? It might be because of to return the excess cash to the shareholders, to improve the return ratios, to signal that the stock is undervalued. The various impact of this might be the shareholders get cash, fewer shares means higher EPS. This can lead to price rise. It is a sentiment booster, especially if it is offered at a premium. Now we'll talk about the types of buyback. First is tender offer, fixed price and quantity, and it is offered to all the shareholders. Second is open market. Company buys over time from the open market. For example, Infosys, TCS, HCL Tech have done multiple buybacks in the recent years. Buyback का मतलब होता है कंपनी अपने शेयर्स में विश्वास दिखा रही है. Now we'll talk about stock split, that is making shares affordable. Stock split का मतलब है dividing the face value of the shares to increase the number of the shares. Example, 1:10 split. इसका मतलब है face value changes from 10 to 1. You had 10 shares at rupees 1000, so now you will have 100 shares at rupees 100 each. But why do companies split the stocks? The answer is because it improves liquidity, makes the high price stocks affordable to the retail investors, and psychologically attracts more participation. The price adjusts accordingly, but your total holding value, it remains the same. Now we'll talk about the right issue, that is raising money from the existing shareholders. In a right issue, company offers the existing shareholders to buy the additional shares at discount in a fixed ratio. For example, 1:5 right issue at rupees 200 when the stock trades at 300. This is a way to raise capital without going to the public or the banks. Its advantages for the investors are discounted price. You can choose to subscribe, sell your right, or just ignore it. And its impact is it can dilute equity if not subscribed. It may lead to temporary price drop due to the dilution fear. For example, Reliance did a massive 53,000 crore right issue in 2020. It was the biggest ever in the Indian history. Corporate actions might sound like a back-end event, but as an investor, these can significantly impact your wealth, both positively and negatively. The key is to understand the why behind every action and not just the what. So the next time a company announces a bonus, dividend, or a buyback, don't just follow the headlines. Analyze the reason, read the company's intent, and align it with your investment strategy. If you like this video, hit the like button, subscribe to our channel, and do comment below and let us know if you have ever gained or lost due to a corporate action. We'll meet in the next video. Till then, take care. Happy investing.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing. The securities quoted are exemplary and are not recommendatory.